Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast app, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 33 in our series for 2021, and today's date is Friday, September the 17th. First, I'll be talking to Joseph Vartuli, CreditorWatch's CTO, connecting over 50,000 Australian businesses with sophisticated credit risk management tools to navigate the economic turbulence of 2021 by assessing the ability of their creditors to pay what they owe. And I'll be talking to IFM Investors economist Alex Joyner about the state of the economy. But now, let's talk to Joseph Vartuli.
Well, Joseph, can you start by telling us a little bit about CreditorWatch?
Yes, thanks, Leon, for having me on. But basically, look, CreditorWatch started a little over 10 years ago by two founders, Colin Porter and Patrick Coughlin. Colin's has since moved on, and Patrick is our current CEO. So we've had some longevity there. But basically, the way it originally started was that Colin and Patrick were in advertising and needed a way to be able to share information about businesses that were doing something called debt hopping, where that's the kind of practice of, you engage with a small supplier, you work with them for maybe a little while, you go onto an invoice basis, but when that invoice comes due, you kind of pick up and you go somewhere else without paying. So then you find that there's this network effect of the same businesses that don't actually constantly not paying people, and it's generally the same offenders. The idea was to kind of create a crowdsourcing model of sharing businesses that were kind of dubious in that sort of practice. Over the 10 years, that's kind of grown into where we are today.
Yes.
From these small businesses to these large enterprises where we're able to provide deep dive insights into businesses and their practices.
Well, what work has your team specifically been doing this year, and how has this been helping Australian businesses navigate the current economic climate?
Yeah, look, so COVID's obviously been a challenge globally. In Australia, especially now, Queensland, a lot of the eastern seaboard, with New South Wales, Victoria being closed, Queensland having to go through, a really tough recession with tourism extremely down at the moment. Western Australia is segregated as well. What we're finding is that it's changed the landscape quite a bit, and it's really hurting certain industries more than others. Some have become actually a little bit more profitable. You can kind of think about the e-commerce websites and anything else to deal with online ordering has really skyrocketed. But what businesses need in terms of some sort of like live information is how are particular industries performing, and where's my risk in terms of my ledger, in terms of how many businesses in these particular risky areas or industries do I need to start being wary of? So a bit more of a deep dive insight into how your business is performing and region and industry risk factors. We're also providing a lot of data through to our government through an economic index to able to give them insights into real-time trade payment behavior of both individual businesses, but on top of that, industries and geographic areas.
So what approach have you taken to building CreditorWatch's development team or DV team, and how are you balancing high-performing culture with a supportive work-life split, particularly in light of the pandemic-induced working from home conditions, where I assume you are now working from home?
Yeah, so look, it's a challenging time for everyone. I think as technology experts, we don't shy away from the ability to be able to work remotely. However, it's really changed how people view remote working. I think the first few weeks of the lockdown, there was a bit of a novelty about working from home and the time-saving measures, but then it quickly became obvious when it was going to be a really permanent stance that are people's work from home environments set up the way they should be? Do you have a distraction-free environment? Do you have enough rooms with, often a partner working from home as well? Throw in working from home, homeschooling as well. It's become an interesting challenge. So look, flexibility has been what we've always been proud of. We provide a lot of autonomy to our developers and kind of give them goals, and kind of we need to be a lot more flexible during these periods. We're finding as well, that the 9-to-5 model doesn't work at the moment. It's just unrealistic given everything happens. So, people need breaks throughout the day. They need to find a little bit more autonomy in terms of how they manage their current workload and deliver that on that weekly workload each and every week. So giving them that autonomy and giving them that ability to kind of choose themselves when and how they work is a big part of it. Supporting them in terms of resources, whether that's working from home stand-up desks or chairs and everything, has played a big part in that factor as well. We've also gone above and beyond and given all of our developers an extra day off every month to kind of take a long weekend on each and every month to kind of let them recharge well during this pandemic period.
Obviously, there's skill shortages we're seeing across Australia right now, particularly in the development space. How are you guys tackling that? And where do you find the developers from?
That's actually a really interesting question, because developers themselves do have quite a bit of leeway now in terms of where and what they want to be working on. So if you don't provide those interesting projects, if you don't provide them with competitive salaries and a work environment where they can feel comfortable with, they can pick up and leave fairly easily right now, especially if you're a developer that's joined during that pandemic period. You don't really have had any team bonding experience. There's no real relationship to the business. You're kind of just there to get a job done, and it's just loyalty kind of goes out the window in a scenario like that. So we've been heavily focused on some online team bonding experiences, some continual education to make sure that they do feel part of a growing and loving network. We obviously provide, like everyone else, little care gifts and packages every month to kind of make sure they know that we've been thought about. And then on top of that, I think you need to start looking remotely. Look, developers have changed their opinion in terms of how many days they'll come back to the office. And that's going to be a permanent change. So I think now you can probably open your horizons a little bit. If you're traditionally a business and just in Sydney, start having a look up and down the eastern seaboard, or start looking into Perth or South Australia, where there's still quite a bit of talent there to be found. If you're even keen, looking a little bit across the shore over at New Zealand, there's a lot of talent over there as well. And a lot of the times, our brothers and sisters in New Zealand are often thought of as just another territory, part of Australia, really.
Right. Okay. But I mean, the question is, how, and this change in the work environment where they'll come and go and be highly flexible, that's pretty permanent?
Look, I think we'll have a remote working lifestyle fairly permanently. I wouldn't go back to complete remote. I think there needs to be a bit of bonding, but I think it's something that you need to discuss with your developers and understand what do they want and what does the business need. So I think even during when the lockdown sort of ended in March, April of this year, and we started returning back to work, we ended up at a 2-day-a-week policy in the office, and that worked really well. We found that there was plenty of bonding periods going on. There was plenty of healthy discussions, but people had that flexibility as well to work from home.
Right. Okay. So, what tech developments are you excited about, both from within CreditorWatch and across the wider development space?
So, look, for me, it's definitely the data analytics side, machine learning, AI. It's gone gangbusters, I guess, in these last sort of few years, mainly because the tech has become accessible to where it was kind of originally with PhD and researchers for quite some time. It has kind of dropped down so that your developers now have access to these tools, and the modeling and the languages that have really developed over the last sort of 3 to 5 years, meaning that most people can start getting some very, at least basic information through their platform to understand what is it in their data set. So they could either monetize, which is something that obviously we've got a lot of experience in, but a lot of businesses don't realize that there's probably some rich data. But even on top of that, if you're not looking to monetize that data, have a look at what trends you're finding, whether you can find any great insights into your business that you can seize some new opportunities in.
So artificial intelligence will become absolutely critical.
Oh, I think there's something like 70% of CEOs globally think AI is going to play a big role in the next sort of 5 years in most industries, if not all. So I think even if you're not keen or don't really understand it, I think you should start dabbling in it. It's definitely going to be a big part of the next sort of 5 to 10 years for every single business, regardless of whether you're in tech or not.
And Joseph, thank you very much for your time.
Thank you so much, Leon. And great to speak to you.
And now let's talk to IFM Investors economist Alex Joyner.
Well, Alex, Philip Lowe from the Reserve Bank says the economy is going to bounce back once we reach 80% vaccination rates. And he's basing that on the fact that people last time when they came out of detention came back and spent money furiously. However, they came back in a zero COVID environment. That's not going to happen this time. Do you think the economy, do you think he's right? Do you think the economy is going to bounce back the way he says?
Look, I think I somewhat share the optimism that the Reserve Bank has in terms of a Q4 rebounding growth. And the reason I say that is more because there's so much pent-up demand. So people in New South Wales and Victoria in particular have things to do, want to do things, want to spend on things. So there is that pent-up demand story, and I think inevitably Q4 will be better. It's just how much better that can be. And as you say, it's going to be an environment where, yes, we're going to have high vaccination rates, but we're also going to have high case numbers. And that's really the experience that we have had overseas. And in that environment, people tend to be a little bit more cautious as to what they can do and what they want to do, what they're comfortable doing. And governments will be like that as well. And one thing that's really noticeable when you look at all these mobility indicators and sort of activity indicators across countries is that even in the high vaccination rate countries, people haven't gone back to normal or haven't gone back to the normal way they do things. So activity is still lower than it was heading into this crisis, and that's going to impact economic activity. And what we've really seen around the world is that we're approaching this narrative of sort of peak growth. There's been quite a few economic growth downgrades, just because countries haven't kept that momentum in the snapback. So in the Australian context, while I think Q4 will be good and we should take some of that momentum into 2022, I don't think it is going to be the sort of an unambiguously strong growth and trajectory out of this pandemic-induced recession that the Reserve Bank is envisaging.
Right. Okay. So what kind of growth are we looking at then for 2022?
Well, the numbers will be strong because of base effects largely, and we will be getting some momentum. So we will see some very strong numbers overall, but that's just to be expected because we've had huge restrictions. Now, as the lockdowns have continued over the last few months, the downturn that we're seeing in Q3 has just got deeper and deeper and deeper. People started that out as sort of, it could be a -1%, -2% decrease in real GDP in the third quarter. The Reserve Bank's downside case was a -2.5. We shot through that pretty quickly as the lockdowns went on. Now you're seeing forecasts of -4%. I've seen -5% in that sort of ballpark. And sort of perversely, as we continue to downgrade Q3, we continue to upgrade 2022 because of that base effect. So it's really not giving a strong indication year on year of the sorts of growth rates that we can expect going forward, just because of that bounce out of what is going to be extraordinarily weak growth in Q3. And it has sort of tossed up this somewhat silly argument, I guess, around are we in recession or not? Because happily enough, the June quarter GDP data came in a little bit better than expected. And if we're expecting a Q4 rebound, we won't get a technical recession, that is 2 consecutive quarters of negative growth. But no one would suggest that Victoria and New South Wales in particular are not in recession. Sort of the duration argument around what a recession is a bit silly in the context of what is going to be a historic sort of fall in GDP of -4, -5%. Where we haven't seen it come through yet is in some of the labour force numbers, but I think that's only a matter of time as to how high we see the unemployment rate go in the next couple of months.
Well, the issue with unemployment numbers is, a lot of the people who aren't working because of the lockdowns are still classified as being employed. And if you add those, that would actually increase the unemployment rate quite substantially.
That's right. So the unemployment rate in the latest figures in July came in a lot better than expected. You know, the unemployment rate actually went down, the official unemployment rate, as the ABS notes the unemployment rate. So it was at 4.6%. But that was really masking what was actually happening in the data. And as you say, if you work 0 hours there, but you keep your job, you are still employed, but you're not working, if you get what I mean. And so there's an obvious income impact there. If you add those people to the unemployment rate in even July, you go from 4.6 to 6% in terms of the people that are effectively unemployed, as you know, the impact on their incomes, for example, is equivalent to being unemployed. That will continue to rise in the August and September numbers as people have had to be out of the workforce. One of the interesting dynamics that this has thrown up, and we've only got these data to the second quarter, is that there is now a record number of people that have multiple jobs. And that seems to be a pretty reasonable response here, because if you get 0 hours in one job, then you might go and take another job. So in the numbers to the June quarter, you know, we've got over 800,000 people having multiple jobs. So maybe 2 jobs, but you know, even 3 or 4 jobs, just to compensate for what's happening in the labour market in terms of their perhaps main or preferred job. That's historically high. It's around about 6.6% of the labour market. So it's a big number. And this is just purely a consequence of the lockdowns and how people are trying to keep their income levels, or the income coming in, so they can, you know, pay their bills and pay their mortgage.
The other issue too is the closed borders internationally. We're not going to get migrants coming in, and that's always been a big driver of economic growth, and that's not going to happen for quite some time.
That's certainly true. It's a double-edged sword. So we don't have the population growth driving GDP, so we just don't have a bigger economy. That's not really a good way to grow, but it certainly was the way the Australian economy was growing leading up to the pandemic. You know, we had this sort of 1.4, 1.5% year-on-year population growth rate, which was making our economy bigger just by the virtue of having more people in it. Now, it's a little bit of a lazy way to grow in an economist's eyes. You know, productivity was quite poor and these sorts of things. But you know, we had relied on it, and we don't rely on it now. The other aspect of that, obviously, is the education and tourism side of things, where you know that has been cut off as a source of growth. Now, services as an export was really going very strongly leading into the pandemic, and that's for naught. At the moment, with borders closed. Now that will come back gradually as borders reopen, international borders reopen. But there's also been a flip side to this on the labour market. You know, one of the reasons why, and it's often overlooked, one of the reasons why we have been able to make so much progress on the labour market and getting the unemployment rate down after the worst of the lockdowns in 2020 is that we haven't had that labour supply coming in. So we haven't had to have all these people getting jobs. And I'm not talking just about skilled migration here. I'm talking about temporary migrants that come to Australia and work in casual jobs and these sorts of things. And it's interesting, again, in the labour account data, it has shown the impact of what having a whole bunch of people in Australia temporarily does to the labour market. So what we can see from those data is that around about 200,000 non-residents have gone home since the start of the pandemic. And that has left 200,000, roughly, free jobs available in the Australian labour market. And I should note here, and it gets a little bit technical on sort of economics detail here, that the labour account data shows employment that includes non-residents. The labour force data that we all focus on as economists month to month doesn't include non-residents. So we have 200,000 non-residents leaving as of the June quarter, and we have those jobs being taken by residents. So that's why you see employment measured in the labour account data lower than it was at the start of the pandemic, but employment still in the labour force data higher than you saw at the start of the pandemic. So it's a very much a substitution effect here. And this is why we're seeing all the anecdotes out there of labor shortages and we can't get people to work, and people in cafes and people in even like agriculture, fruit picking, these sorts of things, that we always tend to rely on the overseas temporary workforce. Those people aren't there, and that's where we're sort of seeing some of the wages pressures, and that's why we're seeing things that we haven't seen before in vacancies numbers and ANZ job ads and Seek job ads. That there's a very high level of vacancies out there and jobs out there, just because these people that used to work in our economy just aren't there anymore because they've gone home because of the pandemic.
Given that we're going to have a gradual increase in immigration, what impact do you expect that will have on the economy?
Well, clearly, the way things are going, the international borders will open up at a gradual pace, likely to select countries that have certain vaccination rates and all these sorts of things. I don't think there's we haven't really got a clear roadmap, at least in Victoria, of coming out of the pandemic here with, borders going to New South Wales and South Australia, let alone an international plan. We haven't got that as yet. Hopefully there's one forthcoming. But I think it will be a very slow march back to the levels of net overseas migration that we have been used to in the past. Now, the last budget did have some sort of a bit of a stab, I guess, at net overseas migration numbers, and had that coming back to sort of the pre-pandemic levels of 300,000 people coming in. It's very difficult to envisage that coming back very quickly as we open up. Because of that, I think selective and very careful reopening of the international borders. And that's going to weigh on economic growth, as I've already noted. But it will also keep the labour market quite tight, because we just won't have that labour supply coming in at a rate that we did pre-pandemic. And that was one of the key reasons Australia couldn't get its unemployment rate as low as other countries before the pandemic, was just we had this level of labour supply coming in that was just, we couldn't absorb it all. And get the unemployment rate to where we wanted it to get the wages up and these sorts of things. So we will have that opportunity as the borders open up very slowly to continue to do that. And I think that's really driving some of the Reserve Bank's policy here, is that it's trying to sort of make hay while the sun shines. So, really keep policy extraordinarily accommodative, which it is, for an extended period of time, to really drive that unemployment rate lower, allow the economy to generate lots and lots of jobs. But then on the labour supply side, we're not having to create those jobs. So the labour market should tighten up quite well, sort of into that 2022, early 2023 period, when the borders are unlikely to be fully open.
So all up, you would say, while the economy is going to bounce back its sorts, it's not going to be a big bounce back. It's going to be quite moderate. Well,
that's right. And look, one of the things that I've sort of been talking about for a long time has been, yes, the economy will no doubt recover. That will happen. We will reach the same level of output as we had before the pandemic. We already did that. We're going to sort of step back from that and return to it. It's a little bit more questionable around how aggressively and how we can keep the unemployment rate very, very low. We need to get that unemployment rate back to, down to 4% or thereabouts to get the wage growth that we would like to see. But how are we going to sustain all this? The economy, as I said, will no doubt recover, but will it be better is, I think, the question. And that is a very open question. I don't see in the Australian context or in the international context, really, what policymakers have done to make economies more robust, make them better and more productive places where businesses want to invest and employ. That was the thing that we were talking about before the pandemic, the over-reliance on monetary policy, and fiscal policy makers and governments really needed to come to the fore in driving economic growth. That is still very much needed after the pandemic. If anything, we're coming out of the pandemic with economies that are weaker. We've got exhausted monetary policy. We're no doubt going to have higher debt levels in the household space and obviously in the government space. But we haven't had these policies that we would like to see around productivity growth and reforms, tax reforms and all these sorts of things that economists sort of talk about till they're blue in the face, because they never really get done and they're difficult to do. So the governments are trying to focus on the recovery from the pandemic. So you sort of forgive them for that. But certainly we need to have an agenda going forward over the medium term to try and make our economy better, more resilient to these things, and not as reliant as we have been on things like population growth, but also iron ore. Obviously, that has been the one thing that has differentiated the Australian economy through this, and will set us up well, hopefully, going forward, is that that reliance on the resources sector. Hopefully we can turn that into something a little bit better than we have previously, where we just sort of gave tax cuts and these sorts of things. Hopefully we can translate these sorts of things into sort of more meaningful reforms in the economy.
Well, Alex, that's all fascinating, and thank you very much for your time.
Pleasure, Liam.
So what's happening in the news? Well, September, the most dangerous month of the year on the share market, is looking more dangerous than usual, with a burst of warnings on an impending correction. Australian blue chips have stumbled from their record highs in August, threatening to end an 11-month run of gains despite fresh optimism on the country's vaccine rollout, as investors prepare for a lull in profit growth. The S&P ASX 200 has fallen nearly 2% since the start of the month, and is down 3% from a peak a month ago, placing the benchmark on track for its first monthly loss since September last year. As independent economist Jonathan Payne says in his most recent report, if the market is about to experience its first meaningful correction of 2021, now is a pretty good time for it to happen. Why now? Analyst concerns range from the reappearance of inflation to extended COVID-related interruptions to suggestions that profit recovery has now peaked. More pressing is a prospect of a taper tantrum on global markets as central banks try to wind back their money printing programs. As concerns mount, the unbroken chain of good news for share investors looks ever more fragile. And the Reserve Bank would face its first independent review in 40 years under a proposal from the OECD, which says it is time to address the central bank's failure to meet key economic targets in recent years and deal with long-term risks posed by the pandemic. In a broad-ranging report into the state of the Australian economy that also called for substantial tax reform and more explicit budget repair commitments from the federal government, the Paris-based Organisation for Economic Cooperation and Development said a review of the RBA should cover its charter and board makeup. The RBA sets official rates and attempts to keep inflation between 2 and 3% as part of its charter to deliver full employment while maximising the nation's prosperity. It has missed its inflation target since 2015. Shadow Treasurer Jim Chalmers said at the time the RBA was not beyond criticism, backing a review of the bank, monetary policy and its interaction with fiscal policy. The same series also showed concerns about the bank's internal structures, including its board, which is appointed by the Treasurer of the day. During a period when it consistently overestimated the strength of wages growth, there was no union representative on the board. Every 18 months, the OECD conducts a formal review of member countries, making recommendations across a range of economic policies. Its latest report is the first to propose a review of the RBA and its operation. Treasurer Josh Frydenberg is open to an independent review of the Reserve Bank of Australia, following calls from the OECD for a probe into why the bank has consistently failed to meet its economic targets. Such a review would include looking at the key lessons from the COVID-19 crisis, implications for interest rates being stuck at historic lows of 0.1%, the bank's inflation target, and its board structure and transparency. And the Morrison Government is being urged by the OECD to reduce its reliance on income taxes, overhaul the GST, lower tax concession, and develop a clear plan to reduce debt coming out of the coronavirus pandemic. The Australian economy faced challenges before COVID-19, and structural reform is needed to rein in the budget and boost business dynamism and productivity, according to the Club of Wealthy Economists, now headed by former Finance Minister Matthias Cormann. The OECD recommended the government reduce its reliance on income taxes, increase the rate and broaden the base of the GST, lower retirement tax concessions and capital gains discounts, and develop a clear medium-term plan for the budget with targets based on timeframes or conditional on measurable outcomes. States and territories also need to get on with major reform, to scrap stamp duty and move to broad-based land taxes, overhaul land use regulations and progress legislating mutual recognition of occupational licensing. And tens of millions of annual visitors to Crown and every worker will have to be fully vaccinated to access the mega attraction under a bold plan. The hospitality giant has written to all its 20,000 employees across Australia, informing them that discussions will begin immediately regarding the introduction of mandatory vaccinations for staff and visitors. The no jab, no entry policy would apply to all its facilities, including Crown Melbourne's gaming floors, hotels, shops, restaurants, cinemas, nightclubs and amusement centres. Crown Resorts and Crown Melbourne Chief Executive Steve McCann said, "Our starting point will be anyone who works or visits our facilities will need to be vaccinated across the board." And more than 1 million people could be vaccinated at work after Australia's businesses were given the green light to join in the rollout and turn offices, warehouses and construction sites, factory floors and mines into vaccination centres. Following a sustained push by the banks, airlines, supermarkets and others to join the vaccine push to reopen the economy and keep it open, business leaders were given the go-ahead during a briefing on Monday with Rollout Coordinator General John Fruin. The plan, made possible by a supply surge of 36 million Pfizer and Moderna mRNA vaccines over this and the next 3 months, will involve a business enlisting an accredited vaccine provider, which would then send nurses or other medical personnel to the business to vaccinate staff, much in the same way businesses arrange annual flu shots for workers. The program is expected to be underway by the beginning of October because due process stipulates that providers must first seek accreditation to administer COVID-19 vaccines at workplaces through the Commonwealth tender process. The government will pay the provider a fixed price for each vaccine administered, meaning there will be no cost to the worker or the business. Businesses cannot charge workers for their jabs. The government estimates between 1 million and 1.7 million people could be vaccinated at their workplace through the business program, which will augment the doses being administered through state government vaccination hubs and the Commonwealth-controlled network of GPs and pharmacies. The Business Council of Australia, which has been working on the program for several months, said enlisting the nation's largest employers was a no-brainer. And the US audit watchdog has fined KPMG Australia US $450,000, that's 615,000 Aussie, over widespread cheating on tests designed to ensure partners and staff act with integrity and have the relevant skills for their work. More than 1,100 KPMG partners and staff were involved in improper answer sharing when taking training tests, where they either received or shared answers between at least 2016 to early 2020, according to a decision published overnight by the Public Company Accounting Oversight Board, or PCAOB. The board has forced 2 partners to retire over the cheating, while another 16 partners received formal warnings and had their income docked by tens of thousands of dollars. Another 30 KPMG staff members received warnings and had their pay docked, while another 1,131 staff members, or about 12% of the firm's total personnel, received verbal or written cautions for either sharing or receiving exam answers. And women's progress to financial equality with men suffered a setback in the June quarter as COVID shock factors put the brakes on the female-led recovery at the start of 2021, the latest Financing Women's Index, or FWX, June quarter report shows. While the FWX rose by 0.9% to 72.2 points in the June quarter, the pace of progress is slower than the 1.06% recorded in the March quarter 2021. The June quarter result was helped by a fresh record high in the number of women occupying ASX 200 board positions to 33.5%, and a narrowing of the gender gap in the underemployment rate. However, digging deeper into the closing of the gender gap in the underemployment rate, it appears less affected by actual progress for women and instead reflects more women opting out of work. In the March quarter of 2021, the Australian economy was picking up, helped by female-led employment recovery in sectors most hit by the pandemic, such as retail, trade and food, and accommodation services. However, the recovery started to come off the boil in June, and the number of monthly hours worked by females fell by 2.3%, almost 5 times that seen among males, and contrasting to a 4.6% gain for women in the March quarter. The gender pay gap also widened to 14.2% from 13.4%, reflecting the biggest dollar difference, or $261, between men and women's full-time weekly wages since 2016. It will take at least 21 years for parity to be achieved in the gender pay gap, at least 31 in employment, 16 years in the underemployment rate, and 7 years for the 50-50 gender diversity to be achieved on the ASX 200 boards. Overall, the most significant obstacle relates to unpaid work. It will take 101 years before equality is achieved in this area, and before we can say equality has been achieved across all areas of financial inequality measured in the FWX. And Reserve Bank of Australia Governor Philip Lowe has dismissed suggestions interest rates could rise next year, insisting the cash rate will be on hold until 2024. In a keynote address to the Inequality Foundation on Tuesday, Dr. Lowe said interest rates will be on hold for the record low of 0.1% for at least the next 3 years. And a measure of Australian business conditions showed a welcome improvement in August as sales and profits weather coronavirus lockdowns in parts of the country, offering hope of a speedy recovery once restrictions ease. Tuesday's survey from the National Australia Bank showed its index of business conditions rose 4 points to 14 in August, recovering part of July's sharp 14-point drop. The survey's measure of confidence edged up 2 points to -5 after diving in July as lockdowns spread from Sydney to Melbourne and Canberra. Importantly, the conditions index remained well above the long-run average, and businesses were faring much better than during the first round of lockdowns last year. And multiple US television networks have approached national broadcaster the ABC about buying the rights to broadcast 2 Four Corners episodes that looked at Fox News and its role in the 2020 general election. The ABC has spoken to several news outlets about a licence to exclusively air their program in the US. CNN, which recently interviewed reporter Sarah Ferguson, was one of the networks interested in acquiring the program, but no deal was finalised. A program detailing Fox News coverage of the general election is likely to be of interest to US television viewers who until now have been unable to watch the program. Fox News is America's most popular cable news network, known for its conservative commentators including Tucker Carlson and Sean Hannity. The licensing of the program by any US television network is likely to frustrate Fox News media and escalate tensions between it and the ABC. Fox News had formalised a complaint about the 2-part program and had written to ABC Chair Ita Buttrose and Managing Director David Anderson demanding an external inquiry be conducted. Fox Corporation, which runs the cable TV channel Fox News, is facing several lawsuits in the US over its coverage of the election. And some of Australia's most well-known digital publications are using funding from tech giants Google and Facebook to form their first industry body. Crikey Publisher, Private Media, Mamma Mia, The Squiz and Junkie Media are among 20 publishers that are coming together to form what will be known as a Digital Publishers Alliance. The body will be led by Junkie's co-founder Tim Duggan and will aim to boost visibility with advertisers and give the publications a stronger voice on key industry issues. Other members of the DPA include Future Women, Broadsheet Media, Lad Bible Group and Solstice Media, publisher of The New Daily, who will pay annual membership fees. Google News Initiatives has already provided funding, while the Facebook Journalism Project is finalising its contribution. Mr Duggan assured the tech giants will have no say over the directive of the industry body and its priorities. And Sydney Airport will open its books to a group of suitors after they sweetened their takeover offer to $23.6 billion. Bidders led by IFM Investors increased their offer to $8.75 a share from $8.45, the airport said on Monday. It plans to recommend shareholders accept the bid if, following due diligence, the consortium turns it into a binding offer and the conditions are acceptable. After being hammered by coronavirus restrictions that decimated travel, Sydney Airport is finally relenting after rejecting 2 previous bids from the consortium. The airport had previously argued that vaccination rollouts around the world would allow travel to resume, but the outlook has darkened since the suitors' first approach in July, and Sydney Airport's largest shareholders last month publicly agitated for negotiations for a sale to start. While Qantas Airways is looking to restart international services in mid-December, much of Australia has been stuck in lockdown for weeks as authorities struggle to contain a breakout of the Delta variant. That's delaying an aviation recovery and increasing the pressure on Australia's biggest travel hub. And a report from the Australian Institute's Centre for Future Work shows 40,000 tertiary education jobs, 1 in 5 positions, have been lost in the 12 months to May 2021. The report estimates 35,000 of the job losses were at public universities, with a significant number of TAFE staff also losing work. And that's it for this week. And next week I'll be talking to Drew Coley, Vice President of Growth and Strategy at GZ Go, Australia's first digital supermarket. And I'll be talking to Indeed economist Callum Pickering about the latest unemployment figures. In the meantime, you can catch me on Facebook, Twitter and LinkedIn. And if you want, leave a comment. Wishing you all a safe and